Today we'll be looking at why having 2 million saved doesn't automatically mean you're ready to retire. Over my many years of working with clients who've accumulated substantial assets, I've identified specific barriers that often prevent retirement even with seven-figure portfolios. And that's exactly why I'm making this video for you today, to show you these hidden factors beyond your account balance that will determine your true retirement readiness. To start off, I want to talk about a family who came to us for help at the end of last year. They had right about $2 million in savings, but they were still not able to confidently quit work and comfortably retire. So let me walk you through their story. Joe and Jan, these are fake names, by the way, not the true clients' names. They were both 61 when they came in, and they had about 2 million. They each had about 750 in each of their 401k plans, all pre-tax, and about $500,000 in a brokerage account. They've accumulated a lot of assets and little debt over the years through disciplined saving strategies. They follow the retirement planning advice that's always given across the industry. Max out your pre-tax accounts, save as much on taxes as you can today because you'll be in a lower tax rate in retirement. What they found is that they were actually maybe a little bit misled with those things, and I'll talk more about that later. Joe and Jan, they made significant sacrifices over their many years of saving and investing to get to this point. But they really were very worried that they were making some poor retirement planning decisions right now. They kept talking about this idea of retirement at age 62, but they both had some hesitancy and uncertainty rather than confidence at this point in their life. Despite having done the math and talked to several advisors and used online calculators, they still had that feeling that, hey, I think we're missing something here. So Joe and Jan, they were actually correct with this part of their plan. They did have some things that they were missing. In fact, there were several key components that were preventing them from being confident inside of their retirement plan and being really ready. The key problem that they had was, despite having the $2 million in retirement savings, they were discovering that what they needed was an actual plan in place and a strategy to bulletproof their retirement plan from all the risks that are out there inside of their retirement. The financial industry really conditioned them to focus almost exclusively on the $2 million in savings that they had and forget everything else. But by neglecting longevity, inflation risk, market risk, and long-term care risk, by neglecting these things, they had some real retirement issues. And they had many holes inside of their plan that we needed to fix before they could be confident. Now, if you're experiencing a similar situation to this client that I'm discussing right now, where you don't feel like you're actually ready to retire, just scroll to the description of the video, click the link, and complete the questionnaire. Once you complete it, I'll personally send you a video breaking down your exact situation and give you actionable advice on how to optimize your retirement plan. So what Joe and Jan were experiencing here, it brought me back to my college years. So in college, I had to give a business plan in one of my classes to a local pavement striping company. Now keep in mind, I'd read the books, I studied the books, I've listened to lectures about business planning before, I have examples, but I've never actually done one, I've never actually ran a business, and I'm in college. So I had a beautiful charts put together, a beautiful presentation put together. And when I gave it to my roommate, just as an example of what I wanted to do for the company, he thought they'd hire me right on the spot because he was so blown away. But I still was anxious and nervous because I'd never done this before. So long story short, I gave the presentation. It went okay. They clapped and said thank you, but they never called me back for advice or gave me a job offer on the spot. They were really nervous that they had missed several key aspects of their retirement plan that might leave them impoverished in the future. In fact, Joe and Jan experienced Jan's mother going broke in retirement because of many health issues, a husband passing away early, and a long-term care cost. And they knew that if they didn't properly protect themselves, they might be at risk of the same exact thing. Now that you've seen the circumstances that this client was in, let's examine exactly what they can do to reframe their plan for a successful retirement and how you can apply this advice to your own retirement plan. This will help you see many of the misconceptions side of your own plan and your own ideas, because you'll find that what they had and what they were thinking, they weren't actually ready to retire at this point in time. Then I'm going to give you our recommendations that we gave Joe and Jan and model our financial planning software for you. So the first question we ask is, what withdrawal strategy are you going to utilize for balancing early retirement readiness with long-term sustainability? And here's what Joe and Jan said. We're really advocates of the 4% rule. We think we're ready to retire at age 62, and that's what we're planning to do, is just take out the 4% and increase it for inflation every year. And here's what we educated them on from a do-it-yourself approach, but what we found is that there's a better way to do it. And what we do is we strategically plan for your go-go years, your slow-go years, and your no-go years. So you're going to be more active early in retirement and less active later in retirement. So we need to plan on more spending early in those go-go years and less spending later in those no-go years. And what we also want to do is strategically invest your assets so that the money you're spending today has no risk to it. So if there is a market decline, your income today is protected. And then with the long-term accounts that we're not going to touch for 15, 20 years, we get more equity focused so we have growth. That really gives you confidence in your retirement income today. How is your $2 million portfolio right now allocated between growth income and really protection assets that you're going to spend today? Well, Joe and Jan said, hey, we're using target date funds inside of our 401k plan. That was their response to their retirement readiness, how they were investing the assets. And here's how we educate clients. Target date funds are an awesome way to get started saving for retirement. But once you enter that red zone retirement, anywhere from a year out to 8 years out, you really have to be very diligent about how you're investing those assets. The assets that you're going to spend early in retirement need to be conservative and guaranteed. So if there's a market decline, your income is not affected. And then as we get later in retirement, some of the accounts that we're going to access later in retirement, we can get more aggressive in those accounts and have an equity focus so we beat inflation and get growth from those accounts. That is a strategic way to invest the assets based upon the individual needs that you're going to have. And what we like to do is we like to keep taxes in mind and diversification in mind at this time as well. The next question that we ask them, what safeguards do you have in place right now in regards to your portfolio that we just talked about to battle sequence of returns risk for your first decade of retirement? So what I was getting at for Joe and Jan was this. If you retire in a down stock market and you have to spend money, that's a recipe for disaster. And what Joe and Jan said was this. They haven't really thought about it. They said they're not going to have any debt because it's all going to be paid off in 6 months. My response was this. If we're spending $10,000 today or $11,000 today, it's highly unlikely that your spending is going to go down to $3,000 or $4,000 in retirement. And so what we need to do is strategically plan for those go-go years and get your income guaranteed during those years from guaranteed income sources to protect against market downturns and to protect against sequence of returns risk. It's very key for you to have assets that are protected for that first decade of spending. The next question, after we talked about the cost, so after we calculated your true retirement expenses, we needed to talk to them about how they were calculating their true retirement expenses, including healthcare, inflation, and long-term care cost. They thought they were going to only need to spend a fraction of what they were spending today, or $5,000, $6,000 max per month in retirement. So if something happens, we have plenty of assets to cover it. But they just weren't sure if that $2 million was enough to cover that. Once we actually dug in with these clients, what we found is they were actually spending over $10,000 per month right now. That was their take-home pay. Now, I know the only debt they had was the $800, but it wasn't enough to cover their lifestyle. They were severely underestimating their expenses. Most clients find it extremely helpful if we have our visions and values conversation at this time. This is where we really dream about your future retirement and drill down into your exact needs and your exact wants. The next question, and the last one that I'll share with you, is this. What tax-efficient withdrawal sequence have you mapped out across your account types, your pre-tax and brokerage? And will you strategically hold inflation dollars per year? What about market downturns? And how will you incorporate Social Security? Well, we're going to take out as the IRA accounts first a little bit, I think, because we're going to need some money to spend, but we can get cash out of the brokerage if we need it. And we're probably going to start Social Security right away at 62. Here's how we educate our clients from a spending standpoint in retirement. I never want you to pay more than a dime than you have to in taxes. Part of our planning process is going to be number one, helping you maximize your Social Security benefit, and then get a strategic spending plan in place based upon your exact tax situation. Before I show you the before and after for these clients, I want to quickly highlight several of the key changes that we made for them inside of their plan. And here's the first one that you'll see. The first thing that we changed was their Social Security optimization strategy. As you can see, what the clients were planning on doing was taking as soon as they were going to retire. So they planned to take their benefit early in their retirement. But what we showed them is how they could strategically wait to claim their Social Security benefit. By the spouse delaying till age 67, Jan, and the husband, Joe, delaying till the age of 70, they were able to get over $868,000 more worth of lifetime income from Social Security rather than if they just took the benefit as soon as they could have. That was the first biggest change. Now let me show you the second one. The second big change that we had for these clients was a tax leveling strategy for them. So as you can see here, their tax bracket was going to drastically drop off at the age of 61 and then spike back up again when RMDs kicked in. So what we showed the clients is how they could strategically take some of their taxable income during these years to really level out and lower those overall tax brackets. Here's the final thing that we changed. The final thing that we changed for these clients was the amount of guaranteed income that they're going to have in retirement. So you can see currently they only had about 21% of their income was going to be fixed or stable in retirement. Now, as you know, through our Red Zone retirement planning process, I talk a lot about getting your needs, your fixed income needs covered by fixed income sources like Social Security, annuities, pensions, rental income, or dividends, for example. So what we did for these clients is we were able to get their needs covered by fixed income sources, which allows for a lot more peaceful and stress-free retirement because you're not worried about stock market performance. So here's the overall picture of what the clients were planning to do and how we were able to help them. You'll see with their plan that they came in, what they were thinking about doing, it was about a 70% probability of success. Now, that equates to losing money in retirement and ending up broke before you pass away. We did not want that. Through our strategies, the three that I just showed you and several other ones, we were able to get them to about a 90% probability of success, which is ideal from a retirement planning risk perspective. So again, here's some of the major changes that we made for the clients. The big change that we suggested is they had to wait from age 62 to retire to actually till age 63 and a half to make all of these things happen. And here's what we were able to do for them. We took long-term care risk completely off the table by purchasing long-term care insurance for these clients. So that was one area that we were able to decrease their planned retirement spending because we had protection from a long-term care strategy. In addition to that, the clients thought they needed about $9,500 per month in income, but what we found through our process, discovering what their needs and their wants are, that number is closer to about $11,000 per month. They could have had a sad wake-up call if they entered retirement thinking they only needed $9,500, but turns out to be $11,000. In addition to that, the clients were already maxing out their 401k and adding to the brokerage account, so there's no plan changes there for the next year and a half until they're able to retire. And again, here's their increase in living expenses. Now, I want to walk over here to a couple key changes that we made. One massive change that we made for these clients, they each had about $750,000 in their 401k plans. What we suggested for them to do was take $250,000 of that and put into an income annuity for these clients. What it does is it gave them joint lifetime income as long as one of them is surviving. So what that did is that gave them more of the fixed income that I just showed you on the previous slide, allowing them to have all of their needs covered by fixed income sources in retirement, which is very important. So there is the two annuities that we did for the clients, siphoning out $250,000 for them, putting it into an immediate income annuity for them that's going to produce joint lifetime income. Once we were able to do that, we were also able to reallocate their 401k strategy and their investment strategy to a more growth-focused allocation because we de-risked with the income annuity. In addition to that, these clients were planning on index spending in retirement. So they were just planning on just taking out the 4% rule, for example, and increasing with inflation every year. Through our retirement planning process, we believe in spending stages, like I've talked about, the go-go, slow-go, and no-go years. Through those spending stages, we strategically plan to spend a little bit less income in your mid-70s and a little bit less income in your mid-80s. Through that process, you're able to spend more early in retirement when you're active and want to do things, and a little bit less later in retirement when you're not as active and not as vibrant. So you can see through these changes that we made for these clients, they are able to go from a 70% probability of success to a 90% probability of success, while spending more money than they thought they would have in retirement. In addition to that, a couple key changes that we made for them and suggestions that we had for them was this. We wanted them to get enough cash savings for them to support their spending if there's a market drop or volatility. And so what we did for them is we had a suggestion to have 18 months worth of living expenses saved up in an emergency fund. In addition to that, we want to fully fund their HSA plan for the next 2 years to plan to pay those COBRA premiums from the age of 63 and a half until they're 65 when Medicare starts. All of these key changes that we made for them through our Red Zone retirement planning process led to a much clearer and concise outcome for the clients. With all of these recommendations that we made to Joe and Jan, they really felt comfortable and empowered to make the retirement planning decision to pull the plug on their employment in about a year and a half's time. This was more than enough time to get them comfortable with their strategy, helping them understand how much income they're going to have, where it's going to come from, their Social Security strategy, Medicare strategy, and of course the tax optimization strategy that we talked to them about. So now that you've seen the mindset that Joe and Jan had, let me walk you through why they weren't quite ready to retire and how we were able to help them restructure their plan to prepare for retirement. If you're looking for more help with your retirement plan, I've put together a complimentary retirement questionnaire that will give you personalized insights about your retirement readiness. It walks you through the exact same process that I just showed you with Joe and Jan.